Sydney homes nearly dropped 20%. Let's have a look. Hello everyone, Florian Heise here, and welcome to another episode of Heise Says. I thought we'd have a look at this article from the Sydney Morning Herald while I have my afternoon coffee about Sydney property prices, how they're set to top $1 million again. Isn't that fantastic, everyone? But hidden in this article is the fact that from peak to trough, they dropped nearly 20% in a year. 20% in a year. Now, I can't say that's too surprising, but there would be a generation that is shocked that property can actually go down, like we read earlier this morning. So let's have a look at this and see a different take on this article, because going back up to 1 million ain't that good if you lost it all already. Sydney house owners are set to become millionaires again in February, mortgages allowing. Okay, in February. With other people predicting a cash rate cut, which is now sitting at 0.75. They're predicting it to go to 0.5 and then QE kicking in. But here we go. They're going to be millionaires again in Sydney. The typical Sydney freestanding home was worth $974,000 as the clock struck midnight on Tuesday, according to an exclusive preview of key home price data due to be released by CoreLogic on Thursday. They're lucky they got that exclusive preview. And the median Sydney unit was worth $746,000. Sorry, but I have to laugh at that. Is that with or without cracks? And you actually get to live in these units, or they just want you to get to buy and lose money on? I mean, come on, guys. The amount of construction issues we've seen in apartments in Sydney, you can't blame me for being cynical. The value of a typical Sydney freestanding home tumbled from a peak of $1,060,000 in July 2017 to $865,000 in June 2019. So sorry, over 2 years, not 1 year. Over 2 years, and that's roughly about 81.5% of this, so it's about 18.5% down in a 2 year period. Nearly a 9% loss per year. That's great returns, isn't it? Remember, when we had the peak, guys, July 2017, they're saying that's the peak, and that's just when we started to get the drop in foreign investments into the housing sector. I haven't shown you this graph before. The black line is the percentage of building approvals that were for foreign investors. Just, it heats up the market. All of these things have implications. But a combination of interest rate cuts and an easing of loan serviceability test reignited Sydney's property market in the second half of 2019. Now, does everyone remember why they brought in these restrictions? There was all this talk about dodgy brokers fudging the numbers. I get the feeling this whole Royal Commission has been turned into just an excuse to decimate the competition of the big four banks because their shares went up and all the brokers had more restrictions put on them. And now they're easing these restrictions again. I mean, what's the point? What's the point in having these restrictions to make loan serviceability easier when you just get rid of it when you need to get a bit more fuel on that bonfire? That's our housing market. I mean, I'll bring up this arrears rate. Guys, look at the number of people that have gone up. I know it's only 1.5%, but look at WA and Northern Territory. How many of those people would be in negative equity? One day before the end of 2019, preliminary figures provided to the Sydney Morning Herald by CoreLogic's head of research, Tim Lawless, shows Sydney dwelling prices rose 5.3% in 2019 after an 8.9% fall in 2018. I mean, there you go. And they don't talk about the 2017 one here. It's been quite a turnaround, Mr. Lawless said. Prices have rebounded much faster than anyone would have expected. So there's the question, guys. We'll have to see. We'll have to see in the next 6 months to a year if this is maintained, if the growth is maintained or it levels out, or if it's just in the upper quartile of the market. Because judging by what we're seeing in the auction clearance rates, the low level of reporting for the auction clearance rates, let's look at the economic data like the GDP growth. It's trending down. What's going to sustain this property increase? Because it fell before. Why won't it fall again? Because there needs to be something new. All they're putting forward to us is population growth and ease of access to loans and lower interest rates. So in December alone, prices gained a little over 1.5%. This was a slight slowing in the pace of price growth from November's 2.7% monthly gain, which was the fastest rate of growth since records began in the 1980s. Well, maybe it's because our cash rate is insane. Oh, well, there you go. This is wage growth data too. Not looking good. It's still a very strong rate of growth, but a step down from November, Mr. Lawless said. What was probably slowing the rate of growth down a little bit was we did start seeing a bit more stock, giving buyers a bit more choice. And here's the other elephant in the room, the reluctance of people to sell. Confidence was down. Now they're starting to bring more stock onto the market. The typical Sydney dwelling price, including houses and units, is now just 6.5% below its 2017 peak, having been in the red by 14.9% before the mid-year rally began. Home values in Sydney are now poised to break records for March this year, CoreLogic predictions show. The return of Sydney's freestanding house values to above the $1 million mark will happen sooner still, Mr. Lawless predicts. Sydney's median house value, based on the current rate of growth, will probably surpass $1 million in February, he said. CoreLogic is tipping Sydney's home values to rise 10% in 2020 as investors return to the market in search of capital gains. Or maybe they want to get their money back that they've lost previously if they sold. With the Morrison government's first home buyer loan guarantee scheme in effect from Wednesday, Mr. Lawless said the scheme would do little to help ease housing affordability, with the $700,000 price cap set well below the median value of both houses and units in Sydney. I think it will be oversubscribed. We will see more people want to take part in this scheme than places are available, but it's not going to do anything to improve housing affordability. In fact, it will probably put some marginal upward pressure on prices. However, the impact would not be big given the scheme cap of 10,000 places a financial year, Mr. Lawless said. So yes, there we have it. Arguments for an increase, properties shooting back up to $1 million in Sydney, guys. Back up to $1 million. But remember, what did it plunge down to? And it's trending up. And again, I need to ask you, what is it? What will sustain it? Will population growth sustain it? Will GDP growth sustain it? Well, no, it's slowing down. There's predictions we may head towards a recession. Wage growth? Nope, not really. Foreign investment? No, that's tanked. Building stock. Well, there is a shortage of building approvals, or a decline in building approvals. So that must mean there won't be as much on the market. But we see people are now starting to put more stock onto the market anyway. So is that offsetting that? That could be. That could be. Consumer confidence? No, consumer sentiment is down. What about business? Business conditions slightly up, business confidence down. What is going to pull it in the long run, guys? What's going to sustain it? And this is where I'm asking, what about arrears rates? They're very high in Western Australia, they're high in Queensland, they're going up in the rest of Australia, trending up. So let's just say it does jump up. What's going to keep it? Will there be a flood of new people in there? Will there be some great innovation? Or are we seeing a dead cat bounce? If we start seeing unemployment creep up, underemployment creep up, more people going into arrears, more people unable to service their mortgages, forced to sell, maybe they've been holding off, what do you think will happen then? Will we continue to see growth, or will it ease off? I'm putting that to you guys. Let me know your opinions in the comments below, because it's going to be an interesting year this year, and I think that's the one thing we can all agree upon. Anyway, guys, thank you for watching. Please like, share, and subscribe to the channel. If you want to help support us making new content, we have a Patreon where you can make a small donation. We also have Amazon, eBay, and Independent Reserve affiliate links where we receive a commission that doesn't cost you a cent. And finally, we sell our very own merchandise on the Heise Says blog, where we make pocket squares perfect for your next Easter or business function. Anyway, guys, take care. Have a great day, and I will talk to you all tomorrow. Bye for now.